Welcome to Genscape's Energy Forums. This is John Powell. I'll be your moderator today. We'll be looking at fundamental factors driving crude delivery across the North American supply chain. I am the manager of EIA, Energy Information Administration's liquid fuels market analysis team. We look at refineries throughout the United States as part of our national energy modeling system. We have a very good panel today for you, but first, as you have questions, please take a look at the box. You can type in your questions. If you wish, you can direct it to one of the speakers and submit it for being asked as a question. Today, we have Adam Bedard. Adam is CEO of ARB Midstream, LLC. He's co-founder, member of the board. This is a Denver-based company. His background is over 20 years experience focusing on strategic analysis of the North American energy market. Prior to forming ARB, Adam was the Vice President of Strategic Planning and Market Analysis for NGL Energy Partners. He is a BS in Chemical Engineering from CU, Colorado, and is a certified PE. He also has an MBA in Finance from Wharton. Following Adam will be Warren Russell. Warren is a member of the Energy Commodities research team at Barclays. He's worked with the CME Group and Bunge Global Agribusiness. He holds a BS from Cornell University and has passed 3 levels of the CFA program. Following Warren is Dion Nicely. Dion is Vice President of Rail and Marine with Bridger Logistics. Prior to joining Bridger's Rail and Marine Group, he served as a shipbroker for MJLF and Associates. And prior to that, he was in the U.S. Coast Guard, where he had 4 tours at sea and was a commanding officer in the wartime Arab Gulf during Operation Enduring Freedom and New Dawn. He led the first international Coast Guard mission to Pakistan in 2011. Mr. Nicely has a BS in management with honors from the U.S. Coast Guard Academy and an MBA from the Virginia Darden School of Business. Following Mr. Nicely will be Warren Saxton. He's the oil transportation manager at Genscape. He leads a team of analysts that analyze piping, rail, and marine crude movements in North America. He worked as an intelligence agent in Washington, D.C., and has a Bachelor's of International Business from Murray State University and a Master's of International Economics and National Security from University of Kentucky's Patterson School. Today, we will be taking a look at Western crude production, particularly with the Chicago-Patoka market. We'll be looking at Canadian production and supply into the Chicago market, a North American outlook. Rail transportation, where we'll be looking at rail movement and what the future may hold there. And lastly will be Cushing pipeline expansions and the infrastructure utilization in the Cushing area. With that, I would like to have Adam start with his presentation.
All right, John, thanks very much. This is Adam Bedard. I'm the CEO of ARB Midstream. Hopefully y'all can hear me okay. I know there's been some difficulty hearing John so far. So I'll try and speak up. I'll try and speak clearly, but no guarantees. Today I'm going to talk about the fundamental factors. I'm going to focus on Western Canadian production and the interaction with the Mid-Con market, or the Chicago, Patoka, Flanagan, Wood River market. It's a very dynamic market. It's going to see a lot of changes over the next couple of years as production grows in Canada and shrinks in the U.S. So a little bit first about ARB. As John mentioned, we're based in Denver, but our focus is the inland corridor of North America. We've got, we're developing 2 greenfield projects. One is in the Niobrara. That site got up and running a few weeks back. We'll be moving in drilling materials and other commodities in and outbound. We're also developing a terminal industrial hub in the Permian in Howard County in Big Spring, Texas. We also have a Canadian group and a Rockies-focused marketing group that we move about 20,000 barrels a day of crude, and quite a bit of that is through the Mid-Con market. ARB, we really focus on analysis, identify, and execute. We use a deep quantitative analytics approach to assessing the market and guiding our investment decisions, and I think you'll see a lot of that come through in this short presentation today. So on to the presentation itself. Currently, Canadian production is about 3.9 million barrels a day, Western Canadian production. 3.2 of that, or 82% of total production, is exported to the U.S. via pipeline. So certainly the Enbridge main line is the main artery for those exports into the U.S., and that is the largest component of imports for North America. 2.6 million of all those pipe imports, about 80% flows through that Mid-Con market, Chicago, Patoka, Flanagan, Wood River market. It's certainly a very complex market, has a lot of dynamics, a nexus of numerous pipelines as well as storage and refining capabilities. The Gulf Coast, PADD 3 is the destination for incremental Canadian heavy production growth. Over the past 3 years, PADD 3 has more than doubled consumption of Canadian crude. So as Canadian crude has grown and found new homes, certainly PADD 3 is the destination that's seeing the most rapid growth. PADD 3 having the most complex refiners and having a fairly strong appetite for heavy crude, including Canadian. Currently, there's about 233,000 barrels a day of Canadian supply flowing through PADDs 2 and 4 to PADD 3. So of the 3.9 million barrels a day of Western Canadian production, about 233,000 of that flows down to PADD 3. You do get about another 100,000 that's going by rail, but a pretty small fraction of that Canadian production getting to one of the most complex and largest refining markets in the world in PADD 3. Over the next 3 years, Canadian production is forecast to grow by 820,000 barrels a day. Yes, you heard that correctly. That forecast is Genscape's forecast, but it's also corroborated by CAP and SERI as well. So quite a bit of Canadian production on the horizon, and certainly in talking to producers and looking at upcoming oil sands developments, there's certainly going to be growth in the near to midterm out of Western Canada. And a lot of those volumes, a large percentage, are going to have to squeeze their way into PADD 3, flowing through that Mid-Con market. And finally, the ARBs need to widen to make this work. I'll talk a little bit about this on my last slide, but the ARBs right now, it's roughly $3 from WCS Hardisty to WCS Houston, so not a lot of room there to move barrels down to the Gulf Coast. So Western Canadian production, as I mentioned, it sits at 3 million barrels a day. Since 2008, it's grown from 2.5 million up to about 4 million, so it's been a steady climb in production, a lot of that driven by big oil sands mines developments with high capital costs that take years, if not decades, of planning. So certainly a lot of momentum in Canadian production. Bitumen supply continues to grow, certainly seeing a drop in production from other conventional Canadian sources. But overall, the impact is production has been up, and as you'll see later in this presentation, will continue to grow. This is the CAP forecast. This is historical. This comes from CAP as of June 2015. Of that 3.9 million barrels a day, 3.5 moves through to the U.S. The 500,000, roughly 400,000 to 500,000 barrels a day That's the difference there is getting consumed by Western Canadian refineries, and a lot of that flows through PADD 2. So this is a fairly simplistic representation of the flows from Canada to the U.S. It is fairly accurate. It's developed using Genscape, Crude Oil Logistics Committee, and EIA data. While it does look simple, it's actually fairly difficult to get some of this information. So of the 3.9 million barrels a day of current production, 2.7 of that moves by pipeline into the U.S. Another 500,000 moves by pipeline through the U.S. to Ontario. Western Canadian refiners consume about 432,000 barrels a day of that 3.9. Rail and barge make up another roughly 280,000 barrels a day. This is data from December 2015. All the numbers you'll see on this relate to 2015, but they provide a fairly good representation of how the market moves. For that Canadian production, 305,000 in December 2015 moved to the West Coast via Trans Mountain. 301,000 moved into PADD 4 through the Western Corridor and Express. Of that 301,000, 255,000 was consumed or stayed in PADD 4 by the PADD 4 refiners. So that meant you had about 45,000 barrels a day of Canadian crude, mostly heavy, moving through PADD 4 to other pads. Now this 45,000 a day, it does suggest or show that it's moving through Platte pipeline into that Patoka market. But when you look in more detail at the numbers, it's probably more like 30,000 getting into that Mid-Con market and the rest getting into PADD 3, likely through that Pony to Cushing connection. Looking at Keystone, Keystone moved 560,000 barrels a day in December of 2015. That hit Still City and then split out from there. Of that 313,000 went into the Mid-Con market and 246,000 into that Cushing market. And as you'll see, that Cushing, the ARB in WCS is between Hardisty and Cushing. There is no real ARB between Cushing and the Gulf Coast at this point. But there is movements into the Gulf nevertheless. And that leaves Enbridge, the main line, which is comprised of a number of pipelines. That system has undergone a lot of expansions and growth. In December 2015, just over 2 million barrels a day was flowing through that system. Of that 2 million, about 1.78 million went into that Mid-Con market. So when you look at the overall movement of Western Canadian crude, you can see it certainly moving west, moving down into the Rockies into PADD 4, moving through Keystone into the Cushing and Chicago markets, but that Enbridge line and its subsequent destination into PADD 2 being really the largest portion of that flow, and about 2.3 million barrels a day of Canadian production currently being refined in PADD 2. That number is quite a bit higher than what CAP had developed from their survey. Previously in 2015, CAP had put the Canadian refined number at about 1.9 million barrels a day. So it looks like, based on the EIA data, refineries in PADD 2 are utilizing more Canadian crude than anticipated. That said, there's not a lot more Canadian crude that those PADD 2 refiners can absorb. So you're seeing flows to PADD 3 increasing. In December 2015, there were about 233,000 barrels a day. That's up significantly over the past couple of years. So looking at a little more detail into where that Canadian production enters the U.S. and where it's refined, these red boxes represent the port of entry for Canadian crude. So you can see that 307,000 barrels a day transfers in Duluth, Minneapolis, Minnesota. Chicago seeing 792,000. This is just the port of entry recorded by the EIA data. But what you see is that 2.629 or 2.6 million barrels a day of Canadian crude is entering the U.S. through PADD 2 ports, the bulk of which is Chicago, Peoria, St. Louis, Port Huron, Michigan, Duluth, and then you see Tulsa in there at 167. That's where Keystone is coming in. Looking at PADD 4, you've got 60,000 barrels a day of Canadian crude entering at Sweetgrass, Montana, 28,000 barrels a day in Great Falls, Montana, Casper. The largest after Sweetgrass is Denver at 86,000 barrels a day receiving Canadian crude for a total of 301,000. If you look then at where those barrels are refined, these little symbols look like storage, but they represent refining demand, actual refined volumes in thousands of barrels per day per region. So 307,000 barrels a day flowed through Duluth and Minneapolis markets, and 306,000 of that was refined there. So you can see that balances fairly well. Into Chicago, the Chicago region, 928,000 barrels a day of Canadian crude was refined among a handful of refineries. But you can see how large that Chicago-Patoka market is, not only as a destination and throughput for crude oil, but also for refining capabilities. So of the 2.6 million flowing into PADD 2, 2.3 million is refined in PADD 2, and you get 287,000 flowing through PADD 2. Those flows primarily into the Houston refining market, 148,000 in the sort of Houston Port Arthur refining complex, 57,000 getting to Louisiana, and you see 12,000 barrels a day at Borger. The blue represents barrels of Canadian crude, and this is all grades. It's light, medium, and heavy, but most of it is heavy, hitting PADD 4 refiners. Montana consuming 155,000 barrels a day of Canadian crude. Colorado 23,000 barrels a day. Wyoming 53,000. And then if you look over into that Chicago-Patoka market, 29,000 barrels a day of Canadian crude moved through PADD 4 on Platte into Patoka. That's a smaller number than I had expected, but you're seeing some of that Platte space moving Canadian crude. And then down in the Texas region, you see 16,000 barrels a day of crude that flowed into PADD 4, the Rockies, and eventually made its way to be refined in the Texas market. So that is likely volumes flowing on Pony into Cushing and down south. But this table down in the lower left shows how much crude is coming into which pad and how much flows through, quite a bit of, for a total of 3.49 million barrels a day into the U.S. as of December 2015. And then you look at the east and west coast, you have some Canadian volumes getting into Washington, 187,000 barrels a day. That's a combination of pipe and barge. Some barrels making their way into California, not a lot. And then on the east coast, you have 112,000 barrels a day of Canadian hitting in Pennsylvania and 165 in New Jersey and Delaware City. So looking at what the trend has been in terms of Canadian barrels moving into and then out of PADD 2, looking back in January 2012, about 1.7 million barrels a day of Canadian crude was entering PADD 2, and of that 1.7 million, nearly all of that was being refined in PADD 2. So the difference between that blue area and that black line represents, the black line is what is refined in PADD 2, the blue is what flows into PADD 2. So the delta is what flows out of PADD 2, and it's a fairly large scale from 1.5 million to 2.7 million, but you can see that blue area over the black line has been increasing. So we're seeing more and more of that Canadian crude production going into PADD 2, moving through PADD 2, again, trying to find the market that'll absorb it. And when you look at the refining utilizations of PADDs 4, PADD 2, and PADD 3, PADD 3 is the logical destination for incremental barrels of Canadian production. So PADD 3 has more than doubled Canadian crude consumption from Jan 14 to Jan 2016. It's processed 350,000 plus barrels a day, of which over 220 arrives via pipe. So looking at that same type of chart, but this time for PADD 3, you can see that PADD 3 refined about 100,000 barrels a day of Canadian crude back in Jan 08. It's been on a slow incline, and then starting in January 2014, we saw a rapid increase in Canadian barrels getting to the Gulf Coast as those pipelines out of Cushing Seaway, and KXL move barrels south. There are barrels that do move directly from Canada into PADD 3. Most likely those are the railed barrels at about 100,000 barrels a day in Jan of 2016. But the point of this is PADD 3's appetite for Canadian crude is met mostly through pipes traveling through PADD 2, and we've seen a dramatic increase over the last few years as those Canadian barrels have hit the Gulf Coast. They've pushed out Mexican imports and probably helped to push out some of the Saudi Arabia imports as well as these barrels get blended up with light tight oil. Looking at what is going to transpire on the production side over the next 3 years, this is Genscape's forecast for the PADD regions and Canada. So, this production forecast, as I mentioned earlier, by Genscape for Canada matches fairly closely with other sources. But the forecast is that over the next 3 years, so January 2016 through December 2018, Canadian production is going to grow by 820,000 barrels a day. So that's nearly 300,000 barrels a day per year added into a system that's going to see a lot of change, particularly through the Mid-Con as the Dakota Access Pipeline comes online, as the ETP trunk line conversion happens. But again, the destination being that Gulf Coast. But while Canadian production is growing, you're seeing a PADD 4 decline by 128,000 barrels a day, PADD 2 declining by 273,000. That could potentially free up some pipe space on the main line to facilitate more Canadian crude movements through that system. But the question remains, can those refiners absorb any more heavy Canadian, or Canadian for that matter, in either PADD 2 or 4? PADD 3, meanwhile, the Gulf Coast, when you combine it with Gulf of Mexico, seeing a fairly flat trajectory. You've got fairly robust declines in the Eagle Ford, flat to a little growth in the Permian, and then you've got Gulf of Mexico growing over that 3-year time frame. But some significant changes in oil supply regions and pipelines coming online out of the DJ as well as out of the Bakken will shift flows of the system. Adding all of that up, this is the Canadian balance. So that black line represents historical production. The dashed line represents the forecast. In this case, it's CAP. Apologies for toggling between Genscape and CAP. I kind of treat them somewhat equally, given that they end up in the same place. But our view is that in 2017, pipes are full and rail needs to price itself in to match the growing incremental production supply out of Canada. So that would suggest the differentials need to support rail movements out of Canada. But needless to say, the pipelines are fairly full leading up to that. And recently, Keystone had an incident where some barrels leaked, and they brought Keystone down and then prorated it. But that market is fairly tightly balanced. So if there are any interruptions or pipeline impacts, that could really swing ARBs wildly and cause significant impacts to movements of crude. Finally, my last slide, the Gulf Coast is really the only region that is significantly increasing consumption of Canadian barrels, and the price spreads to Cushing and Houston are currently too weak to support that. So something has to give. If you feel or believe that Canadian production is going to grow like we do, like Genscape does, like CAP does, then those ARBs most likely need to widen over time to make that move possible. Looking at PADD 2, this comes from CAP. These are refined volumes historically, 2012, 2014, and then forecast. So CAP had forecast that by 2018, 2.08 million barrels of Canadian crude would be refined in PADD 2. We're already seeing that number at 2.3 million. So those refiners have outperformed in that regard. But that's about a 3% per year increase. Looking at PADD 3, in 2012, it was refining 130,000 barrels a day of heavy. Sorry, I keep saying heavy. It's Canadian crude, mostly heavy, and that's growing to 486 in 2020. One big caveat with this CAP is it's based on survey data, and that 486 represents a sample set of 7 refiners. So this number is vastly understated, and it's driven mostly by the methodology you use to collect it. still some growth, but PADD 3 needs to accommodate 500 to 800,000 barrels a day of new Canadian production. And the way it's going to get there is most likely through pipes and possibly some increased rail activity through that 2018 timeframe. Looking at the ARBs for WCS, ARBs, this compares WCS at Hardisty to WCS at Cushing. That's the blue line. In mid to Q3 of 2015, that ARB between Hardisty and Cushing for those WCS barrels was as wide as $10. It's now sort of trending around $3.50 a barrel, so a fairly tight ARB. Looks to be being set by the Keystone pipeline, which can swing barrels between Cushing and the Patoka market. And then recently, and I apologize, this is Argus data. I didn't cite that, but Argus started a new WCS marker at Houston. It's that blue line, and you can see it's really sitting right on top of the green line. There's very, very little delta in the ARB, or I should say very little ARB for WCS between Cushing and Houston. So a lot of the barrels that are coming into the market are getting pulled into Cushing, or really more so into that Mid-Con market. So for more barrels to move south to that Houston market, you've got to see that green and blue line start to show some separation. And overall, that WCS spread to Cushing needs to widen out as well. And looking finally at PADDs 1, 4, and 5, you can see PADD 4 historically consuming about 250,000 barrels a day of Canadian production. There's some refining enhancements and turnarounds that'll increase PADD 4 demand for Canadian barrels to 285, but certainly not nearly enough to keep pace with the Canadian production forecast. So that's it for my portion of the presentation. I'm going to hand it over to Warren. I'll monitor any sort of questions, I guess, that come through, and if I can respond to those on the little chat board, I will. Otherwise, I think questions are being held to the end. So with that, thanks for your time. I appreciate it. Thanks for Genscape for putting this on. Certainly, if anyone has any follow-up questions directly from me, feel free to reach out directly. And then with that, I'll pass it over to Warren.
Thank you. So I'm going to be talking about the outlook for North American production. But before I get started, I want to put things into context. We've seen oil prices declining since mid-2014, and since then prices have dropped from around $100 down to the mid-20s before recovering in recent months, and that has had pretty strong implications on or for production, both in the U.S. and globally, and we can see that in the Capex numbers that our company has estimated for 2016. So if you look at the price decline in 2015 and 2016, you've seen globally Capex cut by 23% and a further 26% in 2016. When you put those together, that's roughly a 40% decline in spending since 2014. And there has been some pretty drastic cuts in places like Europe and Latin America, but in reality, the North American market has been hit the hardest. So looking within the North American region, we'll see that between 2014 and 2016, Capex is expected to be declining by around 60%. You're seeing that across the board from small caps all the way up through the IOCs. But at the same time, you're seeing costs reduced as well. So as Capex declines and interest in drilling and completion crews is reduced, you've seen the service costs, which became fairly inflated over the last few years, really come off pretty much in line with the rig count that you can see on the right-hand side there. But with the reduction in Capex, you're going to have different impacts on different types of asset classes. So when we're talking about the North American market being cut by around 60% over the last 2 years, some of that's impacting oil sands, some of that's impacting Gulf of Mexico output, but that is having some near-term but also a lot more long-term implications. But when you talk about shale specifically, the Capex typically lead to more immediate price production responses, and that's one of the reasons why in 2016 the majority of the market is forecasting the shale production in the U.S. and Canada to take the brunt of the market rebalancing, having supply come off. So as CapEx has come off, you can see on the bottom two charts that completion activity has also declined rather precipitously. However, if you look at both of those production lines, they haven't necessarily come off as much as some people may have expected. So through 2016, we're expecting production to decline by around 480,000 barrels a day. Production peaked in April and has come off around 500,000 barrels a day to December. And so looking into 2016, there was sort of a mixed bag with production where Gulf of Mexico output is expected to continue to rise while several of the tight oil basins and other conventional assets are expected to decline. So in particular, looking at places like the Eagle Ford, we're expecting output to be down around 250,000 barrels a day, and in North Dakota, production declined by 120,000 barrels a day year over year, as well as looking at the Permian, you've seen some hiccups there as well, but we're a little bit more optimistic about that, expecting that to come in roughly flat on the year, but with some weak trajectory there. So just breaking out the three major basins, I've basically laid these out with vintage production, so you can see how those vintages have declined over the last few years. I've also included Genscape's medium-term production forecast, which is based on the WTI strip, which I believe they took as of last week. So you can see that, even in a very low price environment, production does begin to turn around. I think the strips for 2017, 2018 were in maybe the mid to high 40s. So that's pretty promising looking forward. Looking at the basins, comparatively speaking, you'll notice the immense growth in the Eagle Ford. Basically, a sharp line upward from around 200,000 barrels a day to over 1.8 million barrels a day at one point. This is South Texas, by the way, so it includes a little bit other production other than the Eagle Ford specifically. But with that growth, you're also seeing much more substantial declines than places like the Bakken and Permian. Permian in particular has relatively, coming into the shale boom, had a decent amount of conventional output, which declines at a much slower rate. So Bakken as well had a small amount of that, but the growth in the Bakken hasn't necessarily been quite as sudden. So looking at the 2014 vintage, meaning all assets or all wells drilled in 2014 and prior, the Eagle Ford declined by around 50%. So that base production heading into 2015 declined by around 50%, whereas in the Permian it's declined by around 30%, and in the Bakken around 40%. So what that means is as you slow down the drilling and completion activity, you're going to see a lot sharper decline in a place like the Eagle Ford than the other two basins. And obviously, we're expecting to see, substantial decline in activity in the Bakken this year, with several producers deciding to hold off on completion activity. And in the Permian, things again look more promising, with producers continuing to drive down costs and really figure out the stacks there and bringing break-even costs down into the 30s. So looking forward, Permian looks to be very promising. So just a few different production trends that we've seen as prices have declined. First, that completion activity has remained much more resilient than the decline in rig counts would suggest. And this is due to several factors. First is the decrease in drilling times that producers have highlighted as they've become more efficient, and with the rigs that they do currently have deployed, and also producers have been naturally drawing down their well backlogs as drilling programs have slowed. Second, I think also important to note is that high grading has resulted in more resilient activity in the core acreage. So if you look at a place like the Permian, you actually have relatively stable core activity relative to pretty sharply declining rig counts in the region, and on a proportional basis, you can see that rig count declines in the Bakken versus the number of completions in the Bakken. Completions have actually held up relatively well. Also, looking at core versus non-core, I didn't have this in the chart, but there are some interesting trends in some of the what I would call non-core areas where the horizontal IPs have actually improved as producers that were less successful in those regions moved out or slowed activity, and on an average basis, those that have figured out those less prolific areas, their higher IPs tend to show a little bit more in the average IPs. So obviously, with the decline in rig count, the market's been focusing a lot on the well backlog. This is one of several estimates of the well backlog that I've seen. Most of them show this natural trend higher in the well backlog count. Not all of this is really due to actively holding off completing wells. Most of it is actually due to just the substantial wrap-up in drilling activity coupled with the incorporation of pad drilling. And the main point of just showing this slide is to show the substantial amount of wells that are out there. The economics of the backlog wells range pretty widely, I'd imagine, and even at $45 oil, excluding drilling costs, there may be some of the wells in this inventory that don't break even, and as a result, they're probably not going to get completed anytime soon. There's also been several different approaches to the backlog. Some have had no choice but to suspend drilling activity and just work only on completions, while others have gone on with business as usual, although at a much slower pace, just given that prices are so much lower. And then thirdly, there are also those, as I mentioned earlier, that have actively held off completing wells with the hopes that prices will rise and they can receive a better return on their investment at a later date. So just a quick note here that if you added around 200 wells per month, you may end up with around 600,000 barrels a day of additional output by year end. But obviously this is a sort of a blue sky scenario where there are no restrictions and no constraints on service activity going forward. So that's something to note. And obviously producers have been feeling various degrees of pain. Some have been burdened by credit issues, others burned by hedges or the lack thereof, and others still who had assets that worked at $100 no longer work today. Obviously, the producers have had to adjust their capital spending accordingly. You've seen a lot of movement with asset sales. You've seen people sell their infrastructure to raise capital. You've seen asset or acreage swaps to help provide more synergies with existing portfolios. And when you look at the hedging activity today versus other years, hedging isn't really, as a percentage basis, much worse off. But obviously, if you compare 2016 to 2015, hedging in oil for large cap coverage, which Barclays covers, hedging activity was around 16% of production, and that was at around $86 a barrel. But looking at 2016, hedging activity is down slightly, around 14%, but that's at around $58, $59 a barrel, so substantially lower prices as a result. So looking forward, we've sort of highlighted this several times before, but there's something very convenient about unconventional production, especially in a market where we're expecting oil prices to remain very volatile. We've already seen a large amount of global projects delayed and canceled. And another thing that is not immediately transparent is the decline in drilling activity in some of the large conventional and some of the offshore assets has likely resulted in accelerated decline rates globally. And at the same time, we've seen shale really move down the cost curve pretty substantially. So with these delayed and canceled projects, and with decline rates accelerating globally in global production, you're really creating a hole down the road with supply continuing to trend, or demand continuing to trend higher, and supply sort of not necessarily having the projects in the pipeline to really replace and grow supply at the same rate. And that's where we think that shale is sort of a short cycle investment, provides a lot of opportunity there. The real question becomes, first, will there be constraints in the service sector that prohibit producers from ramping up production again if prices do rise substantially? And also within the energy companies, will there be delays just due to the amount of headcount reduction that we've seen in recent years? You'll obviously need to bring a lot of brain power back into the industry to help get shale going again going forward. So outside of shale, which over the near term doesn't look quite so pretty, there's one spot of hope for U.S. production, and is really offsetting some of the shale declines, and that's the Gulf of Mexico. So next year we're expecting production to rise by around 110,000 barrels a day. We've had some pretty substantial growth in projects over the last few years as prices trended above or near $100 for several years in a row, and though just starting to see those volumes come online in 2014 and 2015, and there's a pretty robust project slate for 2016 as well, which we've included on this slide. But in general, I think production in the Gulf of Mexico is really the only promising asset or region in the U.S. in 2016. And then in Canada, just briefly, as my fellow presenter highlighted earlier, Alberta bitumen production is expected to continue to grow, as well as we're expecting some small increase in synthetic crude output as well. But this is actually, it's kind of interesting looking at this side by side with other conventional, unconventional crude in Alberta and Saskatchewan, as well as the offshore Atlantic assets, because what you're expecting to grow in your oil sands volumes, you're actually offsetting with declines in these other asset types. So on average in 2016, we're expecting production to really be near flat just due to this. So so that's my presentation of the North American production outlook, and I'm going to pass it off to my colleague. Actually, I got to sift through a few of these disclosures, and then I'll pass it off. So thank you. Dion, do you want to take it from here?
Yes, sir. Thank you so much. Hi, good afternoon, everyone. My name is Dion Nicely, with head of rail and marine at Bridger Logistics, wholly owned subsidiary of Feral Gas. So, we've covered a lot about the production, the increase in production, the decrease in flat price, closing of the ARB. So I think that I should be able to get through this quickly and kind of focus on, well, what does that mean for North American assets, asset utilization, and freight rates? Just a general overview. I know this has been covered quite a bit. A lot of the stuff we're going to focus on here is in the U.S. Jones Act is between Pad 3, Pad 1, cross-Gulf movement, as well as the Gulf to the northeast, and from the rail side from Pad 2 to Pad 1. So just as a historical, EI puts out some great data on, this looks like crude by rail from 2010. As you can see, very, very light, a lot going into Pad 3, probably manifest moving around quite a bit. This is when oil was deeply discounted, no outlets, limited pipeline takeaway capacity, limited terminal takeaway capacity as well. As the opportunities presented itself, the industry boomed, And fast forward until 2014, a lot of takeaway capacity by rail, increased production, oil was trading higher. PADD 1 had a huge thirst for the light sweet coming out of the Bakken. Imports from WAF and the North Sea were almost completely boxed out on the international side. In addition to that, West Texas, Permian, Eagle Ford was moving a lot of oil from Texas up to the Northeast refiners as well, which were resulting in good cracks from the domestic shale. Freight rates reached an all-time high probably in 2013 on Jones Act tankers. Were getting fixed and reletted for north of $100,000 a day. Prior to 2013, averages were high 48,000 to 50,000 was kind of the norm for a tanker, and they were primarily used for clean product service to between the Gulf Coast refiners and Florida. My slides are jumping around here. Sorry. Okay. So, and then what happened, and they've touched, both previous speakers touched on it great earlier. Oversupply, ARBs closed, flat price dropped. We talked about earlier moving from WCS Hardisty to Houston on rail and what the ARB was. Well, the ARB between North Dakota and everywhere tightened real quick. Here's rail production. Carloads coming out of North Dakota. This was, I think, to PADD 1. As you can see, the precipitous drop as basically flat price and the ARB closed. Such did the rail car movements out of North Dakota. I think at a peak, 500, 600,000 barrels a day. Almost trying most terminals that could handle a unit train a day. Well, there was a lot of congestion in late 2013 and 14 over interchange in Chicago. The railroads, this kind of caught the railroads by surprise of how fast this crude by rail moved. But if you could handle a train a day at every terminal was trying to turn a train a day. So you were turning as many trains as you possibly could. As of last week, depending on what data you pull, there might be five trains a day going out of 5 unit trains a day going out of North Dakota, roughly 400,000 barrels a day, which probably a little less than that. It's probably closer to 300,000 barrels a day going of crude being out of North Dakota. That's due to the low flat price and the low ARBs that we've touched on earlier. And here's kind of, if you were to mirror this slide onto the previous slides, you would kind of see the differentials correlate with the movements and the decline in movements. As the ARBs dropped, everything tightened, the movements weren't there, everything's going to shift back to foreign. I'm sorry, not everything, but the opportunities are going to be there for more foreign imports. And here it is. Here's PADD 1 when the ARB collapsed and it became more advantageous to bring in foreign. You saw the pickup up here. You could land in the Northeast at Brent plus, depending on various freight rates. Brent plus 3, Brent plus 2 in some cases, and that's far more competitive than a rail barrel from North Dakota into the East Coast, and also a domestic barrel coming around from Texas into the East Coast. So what does this mean for Jones Act freight rates? Here, I tried to simplify this. I could have put a bunch of different graphs on here, but this is your basic supply and demand curve. Shift of the demand, decrease in demand, corresponding with an increase in supply. Because as shale and the movements ramped up, a lot of ship owners took it upon themselves to order new equipment, which at the time was a smart move. They're disciplined in the Jones Act in that they don't order on speculation like in the foreign market. Most of these charters that were purchased were done so on a 3 to 5 year term, fixed by creditworthy major counterparties at $75,000 a day for new build tankers. The problem with that, when they get delivered, the other ships are going to get redelivered into a fleet which has a lesser demand than it did 18 months ago. The position list is long. 2 years ago, if you wanted a tanker, you could not get a tanker in the Jones Act unless you were willing to pay north of six figures for it. Now you could get one for less than $60,000 a day on various terms. You know, as a charterer, it went from a price taker to a price maker. This graph kind of depicts how you could articulate this for the inland side as well as the blue water fleet, as well as rail car leasing, and you could even make a case for rail car freight on how this was all everything kind of built up and correlated into one big, you know, oversupplied market on the asset side and the under demand side on the domestic side is the global surplus made foreign barrels attractive again. But that said, you know, even though the prices have dropped, this is a little older data, I think from 2015. You know, marine and rail will always be the most competitive on the price curve on a per barrel basis. Outside pipeline, which is generally going to be the cheapest. But places where there's pipeline that can't be reached, marine and rail are always going to be your best options. Then there's always going to be a place for them if the market's willing to make it happen. With that, I believe I'm done. So yes, that is.
All right, thanks, Dion. Good afternoon. So this is Ryan Saxton with Genscape, and I have the unenviable task of going last today. So I'm going to try and make mine relatively brief so we can get to the Q&A. But just a little bit about what we do. We talked about this a little bit, but Genscape monitors about 342 million barrels in North America, and that includes the 90 some odd million barrels in Cushing, Oklahoma. We also monitor close to 100 refineries in the U.S. The majority of what I'm going to be talking about today is on our pipeline coverage, so about 50 pipelines across North America. What I'm going to hone in on is Cushing construction, what we monitor there, what's coming online over the next year and a half. Right now, we monitor about 95% of incoming capacity and about 86% of outgoing capacity. So pretty broad swath of coverage, transportation connected to Cushing there. So just to kind of take a little bit of a look at where we are right now. So this is our Cushing storage trend. This is going to be a pretty familiar story to everybody on this call, but hovering right at sort of all-time highs, so 66, 67 million barrels in Cushing right now. A few draws lately, but certainly still near those record highs. So capacity utilization, we're looking at just under 80% utilization for Cushing storage. What we typically see, and this kind of varies tank by tank, but 85% seems to be about the max that they will go. About 15% of that is left for operational issues, but so we consider that still some room to grow, but just under 80% right now. So looking at what impact pipeline construction might have on the storage trend, other dynamics are clearly going to be more important in the short term, right? So market structure, contango backwardation, other incentives to store, but bottlenecks do certainly matter, as we'll see. And so this is kind of getting to the, actually, I'm going to pick up the phone since I'm being told there is an echo, so hopefully that's a little bit better. So this is kind of the bulk of what I'm going to get into. So some of the pipeline projects coming in and out of Cushing over the next year, year and a half or so. The first up, we have Saddlehorn Grand Mesa pipeline. So this is a pipeline from Platteville in northern Colorado, the DJ Basin, into Cushing, Oklahoma. And so that's going to have an initial capacity of about 340,000 barrels per day, expandable up to 450,000 barrels per day. As our customers know, we recently published an intelligence report on this, so I'm being told you cannot hear me. Okay, there we go. So we recently flew this pipeline's right of way. So what Magellan had been saying is about Q3 of this year for operational start on that pipeline. And so they're coming out saying testing is underway. So what our customers know, which we released this past week, is that they are set to begin operations on that pipeline in September of this year. Committed shipments of about 40,000 barrels per day on that line, and it's expected to ramp up to about 80,000 barrels per day. So the more interesting part of this line is sort of a delayed segment that they're building. They just started securing easements for it in January, actually, is the segment to be built from Carr, Colorado, down to Platteville. So this is going to tie into the Powder River Basin. Most importantly, it's going to be able to draw flows from Guernsey. And so that sort of opens that pipeline up to Bakken flows and Canadian flows. So I really don't expect volumes to increase too much on that line until the additional segment comes on. But that's certainly going to be an important project to watch later this year. So the second one is the Plains Red River pipeline, and that's from Cushing to Longview, Texas. Initial capacity there is 125,000 barrels per day. That's expandable to 150. And that's slated for a fourth quarter start date. Any delay, it might get pushed to early 2017, but right now it's Q4 of this year. So this kind of does a few interesting things, and I'm going to apologize for my schematic. This is not strictly correct. So this is going to actually go from Cushing and then down to near Duncan, Oklahoma, and then at that point it cuts over to Longview, Texas. So the interesting part about this one is that it actually is going to have the ability to pull flows off of basin on the incoming side, as well as accelerate flows on the outgoing side. So it's actually going to be able to tie into Cherokee and the existing Red River system on the outgoing side. So minimum volume commitments on that line is about 55,000 barrels per day, and that's from refiners in Shreveport, Louisiana. And also as part of this project, it's going to be able to tie into the Permian Longview and Louisiana extension. So that's going to run from essentially Longview down to Anchorage, Louisiana. A couple of refineries down there as well with Placid Port Allen and Exxon Baton Rouge. So a few different destinations that those volumes will be able to go. And then lastly, we have the Diamond Pipeline. So this is from Cushing over to Valero's Memphis refinery. And this is initial capacity of about 200,000 barrels per day. Expected third quarter of next year. Been a couple of delays, but right now it's third quarter of 2017. And according to some media reporting, all of those easements have been secured. So I think what everybody's going to be looking at here is once that comes online, will Capline actually be reversed? So I think it's everybody's assumption that the expansion of Diamond will hinge on whether that happens or not. So those are the three large pipeline projects tied to Cushing, at least over the next year and a half or so. So sort of the interesting 20,000-foot level view of what that does to Cushing. So what impact might that have, right? With these expansions, the third quarter with Saddlehorn coming online, that gets us up, the net pipeline imbalance gets us up to about 1 million barrels per day on the incoming side. So that's 1 million barrels per day more incoming capacity than outgoing capacity. So that's something we haven't seen since at least before 2012. So before Seaway was reversed, before it was expanded, before TransCanada's Market Link came online. So not to say all that capacity will be used, as we'll see, and there's certainly some relief once Red River comes online, and even more so with Diamond, but certainly an interesting dynamic to look out for later this year. And so this is sort of an interesting side-by-side, and you can make your own assessments of what the impacts are, right? So this is storage versus pipeline balance and storage versus the 6-month spread, WTI. So of course, each of these things matter at different times. You couldn't have seen the destocking of Cushing as you did beginning in late 2013 without Seaway having been reversed or without TransCanada coming online. So, but obviously, short, medium-term spreads impact where or where not to store. So both dynamics certainly coming into play at different times. So capacity utilization, where we are right now on the incoming side, we're seeing at about 55% utilization incoming, and then hovering just under 70% on the outgoing side. Over the past couple of weeks, I think Adam mentioned this earlier, we did see, as our customers were abruptly alerted to, we did see Keystone going down, and then for about 8 days, and then sort of that reduced pressure since the restart, I think on April 10th is when we saw that come back online. So still not at full capacity. We're actually seeing some indications of what types of testing they're doing on that line. But we expect that to last maybe through April to come online in the next week or two, sort of closer to full capacity. And then regional capacity utilization. So on the incoming side, we're seeing flows from Cushing and West Texas converge around that 50% utilization, a little bit increase from Canada and a little bit decrease from West Texas. So I threw White Cliffs on there as well, which is sort of hovering at about 70-75% utilization, and just did that to show sort of a comparison since Saddlehorn will be coming out the same basin. So it will, just to sort of reiterate again, it will be interesting to see how much of that ends up needing to be pushed onto Saddlehorn. On the outgoing side, Cushing to both Midwest refiners and the Gulf Coast, sort of hovering at the 70% mark, Certainly enough space on the Cushing to Gulf Coast pipelines to handle any sort of destocking. About 30% utilization still available on those lines down to the Gulf Coast. So any of those pure storage trades would certainly have space were that ARB to present itself. And this has been kind of talked about a lot in the previous with the previous presenters, so I'm not going to go too heavy into this. These are pretty familiar charts to everybody. Similar production declines in a lot of the major U.S. basins. Permian, and these are not forecasts, so these are up through April or May. Even in the Permian, we've seen 1 or 2 data points of declines in the past month or two. So I think all of our presenters have talked on this as well. A little bit different story in Canada. So our Spring Rock production forecasting arm has Alberta bitumen and non-bitumen up about 223,000 barrels per day forecasted for this year. That's year-over-year growth. And then Canada as a whole, that's bitumen and non-bitumen again, that's about 98,000 barrels per day this year, and then 203,000 barrels per day in 2017. So a little bit of a different story up there, as was touched on. Some of the oil sands operators lowering their OPEX, certainly longer lead times up there. And then demand for Canadian heavy, I think Adam was mentioning this as well in Pad 2, still going strong. So moving on from there, this is sort of a reference slide that I threw in there for anyone who wanted just the similar production charts, and then with those capacity utilizations for the pipelines coming out of those basins, and those numbers are for March 2016. So those are there if you want it. And then one of the presenters, Brian Bush, showed this slide this morning, but this is sort of just an interesting theoretical exercise, right? So were those ARBs to begin to present themselves, how fast could the glut empty in Cushing? And we're seeing empty storage space on Cushing to Gulf Coast pipelines at about 500,000 barrels per day. So theoretically, Cushing could drain about 3 million barrels a week to those tank bottoms in about 4 months. So you can do with that theoretical exercise as you will, but certainly something to keep in mind that there is space to make that happen. And this is just talking about what we can see over the next year storage-wise, right? So in Cushing, there are some barrels coming online, not a ton, but about 540,000 barrels of storage expected by the end of the year. But the bulk of the storage increase is coming in Pad 3 with Gulf Coast and West Texas. So that's about 20 million barrels of storage expected to come online by the end of 2016. And on top of that, there's another 11 million barrels in a storage cavern that's being constructed by Fairway down near Houston, and that's by the end of the year as well. So the last thing I kind of took a look at, just really for my own interest, but kind of to see what ancillary pipeline activity looked like and what impact that was having on lines down to Cushing, right? So sort of the two main examples that I've seen over the past 4 months or so, actually maybe dating back to late 2015, was Southern Access Extension and Line 9 reversal. So taking Line 9 first, since that's actually what we saw some impact on Flanagan South down to Cushing once that line came on. So that was Enbridge's Line 9 reverse from Sarnia up into Montreal. So we saw a little bit of diverting of flows from Flanagan South onto that line. And then when Southern Access Extension came on, which is Enbridge's lateral from Flanagan down to Patoka, didn't see a whole lot of impact on their existing lines down to Cushing, so Flanagan and Spearhead, but did see some of that with Line 9 reversal. So that's kind of what the pipeline construction looks like, what impact that might have, what it might not have. And so hopefully that has been informative. I'm going to turn it back over to John for some Q&A.
Okay, thank you. Thank you all. Very interesting. As people have questions, please send them in. We are getting some in as we speak. First one goes to Adam. It has to do with ARBs. It's kind of a two-part question. And one is, what do you see the ARBs between, for WCS, between Hardisty and Houston have to be to make the move to the Gulf? And the two-part is pipeline, and then also, what about rail, if you can send the bitumen neat in a tank car rather than as still bits?
Sure. So a couple things there. We are seeing heavy Canadian barrels move by rail, so it is moving somewhere. Presumably some of that is getting to the Gulf. There may be a number of reasons why that's happening, even with such a tight spread. When we look at the cost of rail and what it takes to move barrels out of that Hardisty market by rail down to the Pad 3 Gulf, it's about $16 a barrel. Certainly the rail lines have a lot to say about that. They could change their rate structure and bring that down, but When we last looked at it, it was about a $16 move for a heavy undiluted bitumen. You may be able to get some blend uplift if you're using a rail bit instead of a dill bit that maybe drives that 16 down to a 14 or so. But certainly it's not anywhere near that right now. Pipe economics to the Gulf Coast around $10 to $11 if you're going all the way, say, from Hardesty through Mainline down through Flanagan or Spearhead down Seaway or KXL. But generally, rail is about $4 to $5 a barrel more than those movements on an equivalent crude basis.
Okay, thank you. Next question is for Warren, and that's if U.S. crude prices keep dropping, which, well, they have dropped as of a year ago. Do you see the net back from Cushing for the WCS producer getting below their cash costs? And if that happens, or maybe has already happened, are we going to see shut-ins and project cancellations?
Well, first I'd say, over the maybe January through February time frame, I do believe that you did have several producers that were operating below cash costs. But in general, looking over the last year, you've actually seen a lot of debottlenecking, helping reduce costs for these producers. You also had FX move in favor of Canadian producers as well, helping reduce, if they're selling barrels in dollars, and the Canadian dollar has depreciated by 20 plus %. That obviously reduces their input costs quite a bit. So even though prices did get down below cash operating costs for some producers, I think that it's not quite as bad as it would have looked at another time when producers weren't able to make these adjustments. As far as shutting in production, I think this sort of goes along the lines with every other producer in the world where you don't want to be the first one to shut in. So nobody wants to shut in, and you really need prices to be below cash costs for quite a while in order for people to really, especially in the oil sands, to really want to move forward with that decision. Especially in SAGD, for example, shutting in involves cooling of wells, and there's costs associated with ramping back up again. So if your view is that prices are going to rebound, and at $27, I don't know many people in the market that thought you were going to sustain, a sub $30 oil price for very long. And so I think for that reason, you have seen a very small number of shut-ins, but nothing substantial. But again, nobody with an outlook that prices are going to sit below cash operating costs for only a month or so is going to move forward with that decision. But okay. In the longer front, yes, the oil market volatility along with the lower futures curve, I think, is disincentivizing projects over the longer run, or at least causing producers to reassess the projects, maybe tweak them slightly, make them more cookie cutter to save some costs. So I think that pretty much sums it up.
Okay, thank you. Next question is for Dion. I guess it's a little bit of a loaded question, but what do you think the likelihood is that Congress will repeal the Jones Act? Is that a real possibility, or is that wishful thinking?
Well, I don't know who would be wishing that it gets repealed. Myself, from the military background, I see the value in the Jones Act. I can certainly empathize with the arguments against the Jones Act. I'm not a lobbyist or in D.C., so I'm not sure where it goes. There's strong support from, I believe, Congressman Duncan down in Southern California, where NASCO is. So at this point, I don't think there's been a strong wave of movement to repeal the Jones Act for any particular reason. It's been around for a while, and it's been pretty strong. We look at it in a microcosm. In this case, the conversation that we're having now of, 200 ships that carry clean and dirty products of volumes of consequence. Every ferry, every car transport, be it at your local, city or Staten Island ferry, everything, up and down the river is a Jones Act qualified vessel, and there's about 40,000 of them in the United States. It goes well beyond people's complaints about gasoline prices. So I don't have an answer. I'm not in there, but I wouldn't expect anything to happen anytime soon.
Okay, thank you. And Ryan, for you, this one has to do with TransCanada's Market Link, the pipeline going from Cushing down to Houston. At one time, they were expected to expand to around 380,000 barrels a day. Do they currently have open capacity, take or pay, that is not being used? And if so, what do you think the likelihood is that pipeline will be expanded?
So, yeah, do they have capacity on the line? Yes. I mean, over the past few months, that line hasn't averaged above 400,000 barrels per day. So they certainly have spare capacity on it. So that expansion certainly isn't warranted, I think, even if Cushing were to start destocking, right? And then just from a sort of on-the-ground intelligence aspect, we've flown the pipeline, and they've kind of left open some space along the line on which they could construct additional pump stations and expand that capacity. So they haven't done so to date. We continue to sort of monitor that routinely, but they haven't done it today. And I haven't seen really anything come out of TransCanada lately indicating that they're still interested in doing that, at least in the short term. So I also know that they have some expiring short-term contracts on that line this year. They've kind of released in their earnings forecast that's going to lead to a little bit of a hit for them. But in my view, they absolutely have the capacity on the line. It certainly doesn't warrant the expansion, at least right now.
Okay, thank you. The next question is back to Adam, and you had indicated there was about 820,000 barrels a day of new Canadian production that should be coming on. When you look at the reduction in U.S. production in the mid-continent, it looks to be around 600,000 barrels. Where is that other 200,000 barrels going to go, and what crude might it displace? Do you have any feel for that?
Sure. I don't think it's simply a one-for-one exchange. Most of that Canadian's heavy. That's the growth. Most of the declines in a lighter barrel. So you're going to see a market long heavies, short light. So that light heavy spread will probably start to come in as refiners are incentivized to use more heavy. Generally, though, those barrels from Canada are going to be headed to the Gulf Coast. And if you assume there isn't a huge increase in refining capacity there, those Canadian barrels would need to displace barrels currently flowing in. If you most likely waterborne imports. When you look at data back to 2014, Mexico seems to have lost the most market share on the heavy side, and Saudi Arabia has lost the most market share when it comes to the medium. Certainly those heavies can be used to blend with the light tight oil to go into that PADD 3 refinery. So the previous trends suggest that more medium or intermediate and heavy crudes will get pushed out from waterborne imports, and those to date have come out of mostly out of Mexico and Saudi Arabia and Kuwait.
Okay. Next one coming in is for Dion, and with Brent and LLS in the Gulf Coast, similar in price, what do you think the impact will be on crude by rail movements, particularly to the U.S. East Coast? I think I did see some of that in your slide, but did you want to elaborate on that?
Yeah, the East Coast refiners in PADD 1, they just look at it as a landed cost per barrel, and some of the more complicated refiners are, they can run a lower grade crude. So I guess it's kind of an all-in model, but right now it's cheaper to land a Brent barrel to the East Coast than it is for crude by rail, and that just has to do with the tightening of the TI versus Brent, and also what the lease is traded at in North Dakota, coupled with what we've spoken about earlier, what rail freight has to be to make a barrel work. And then same thing for LLS is, you're pricing of LLS and then put it on a Jones Act vessel. Even at low freight rates, you're probably landing L plus 350 into the East Coast. So if L's trading on parity with Brent, you're probably kind of getting towards a point of indifference. I don't have the exact numbers in front of me today, but I think if you're not going to do much better than 350 from PADD 3 to PADD 1.
And rail cost is about what between those locations?
Well, no one's railing from PADD 3 to PADD 1 to my knowledge.
Okay.
From North Dakota to the cost from North Dakota to it depends on on a freight aspect of it. It's generally $7 to $8 just for freight. That doesn't include load or offload or anything.
Okay. Adam, when the Dakota Access Pipeline comes on stream, which of course is Bakken to Patoka, and it puts, say, another 450,000 barrels of crude into the mid-continent, what do you think the impact is going to be on the refining system and general crude movement?
Yeah, no, that's very interesting. So DAPL, Dakota Access Pipeline, slated to come on stream later this year or early 2017, backed by contracted volumes, roughly 400 to 450,000 barrels a day. A lot of those barrels, I don't have a percentage at my fingertips, but a lot of those barrels will be sort of migrate from rail to DAPL, and DAPL will dump those barrels into Patoka. So you'll have a lot more pressure on those pipelines into and out of that Patoka-Chicago market as more volumes move through. The ETP trunk line conversion should accommodate the flow-through of those DAPL barrels, but that there's still some details that need to emerge on that trunk line conversion. But what you'll also see as DAPL swings volumes, it'll take a lot of volumes out of rail, but also some of those volumes that are currently flowing west out of the Bakken into Guernsey will now flow east out of the Bakken into that Mid-Con market, I think creating quite a bit of congestion on the pipeline system in the Mid-Con.
Okay, thank you. Next question coming in is for Warren. Is capital available for producers to complete their uncompleted wells and to start drilling if they wish to anticipate price increases, crude price increases?
Yeah, capital is available. I think it just depends on at what cost. So also it really depends on what the economics are. So if somebody's really trying to get ahead of the game and drill a bunch of new wells, then I would say there's probably capital lurking out there in the market, but it's probably going to be high cost. So anybody with a weak balance sheet to start is probably going to struggle to take on additional additional capital. So I don't know if that's an answer to your question, but we've heard numerous times that there's private equity money sitting out there waiting to get into this market. I think there's also, if you look at some of the larger producers, they actually have a lot of capital as well, and maybe aligning the the returns that each group requires, private equity versus maybe a super major or a large independent. I think that those are two separate things. So you may, going forward, start to see if prices remain low, a bit more purchases of companies or mergers, but we really haven't seen a whole lot, just because the capital markets have been open, especially for the bigger guys in debt, and then also in equity, anybody that's willing to issue new shares.
Okay. Next question coming in, I can direct to everybody if people have comments. If crude prices increase and, say, WTI gets in the $60 range such that producers are starting to produce more and more light crude, light crude will probably come on fairly quickly, a matter of months rather than years, if the drilled but uncompleted are then completed. What impact do you believe this will have on heavy crude market and on heavy crude runs? In other words, will the refiners run the local light crude and not run imported heavy, either Canadian or waterborne heavy?
Yeah, this is Adam. I'll take a first crack at that. So if we go back to 2 years ago and we get production of light tight oil up, it's not so simple that you can put a light barrel into a refinery in lieu of a heavy barrel. Certainly you can. My belief is that the two enable each other. So Canadian heavies and light tight oil really enable each other to blend up to displace some of the intermediate imports, waterborne imports. But if prices go back to $60 a barrel and we start to see light tight oil production and supply expand out, and refiners now have an abundance of both heavy and light crudes, it kind of comes down to the individual refining economics as to what their diet may be of those two. But you'd probably see your light-heavy spread settle around $8 a barrel, where a refiner's sort of indifferent to either grade of crude, to the extent the refiner can take heavy or light in the first place.
So then it just is a matter of who's willing to cut the price a dime to get their crude into the refinery. That makes sense. I see we're getting close, but there is one last question, which again I'll throw open to anybody who may want to answer. As the forward curve flattens, less contango, particularly for WTI, I know it is flattening for Brent. Do you think that'll impact storage levels at Cushing? And will it be significant if it does? Okay, if no one wishes to take that up, we can leave that as an unanswered question.
Well, this is, I mean, the answer is, yeah, if we go from backwardated to, or contango to backwardated, that's going to cause a destocking of barrels, that you're not going to be able to cover your carry costs in a flatter market. So at some point, the market inflects into a backwardated market and disincentivizes storage.
Okay, so we could potentially see the pipelines leaving Cushing go more towards their capacity, and inventory draws quite pronounced then at Cushing if that happens, I would think.
Sure. Yeah, Oh, go ahead.
No, I mean, Adam had a good answer, but I was just going to chime in. It depends, right? Yeah, of course, we go to backwardation, you're going to start to see some destocking. I think there might be some question around some of these drilled but uncompleted wells as they come online as well, to actually see what sort of impact that has on Cushing. So I don't think it's 100% as straightforward as, yes, it goes to backwardation, yes, it can destock, and yes, there's capacity to do so. But if we start to get in the $50, $60 barrel range, I mean, that's going to bring on some additional production as well. So there's another side of the equation there that we would have to think about.
Okay, good point. I see we're approaching the end of the webinar. I see no additional questions coming in, so I want to thank everybody for their participation. And it's been a very interesting, informative session. I thank you all.